Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full service financial firm headquartered right here in Boulder, Colorado. And I am recording this on Sunday after a pretty interesting week in the unmanaged stock market indexes like the Dow Jones and the S&P 500. Perhaps you read something about it or saw it on the news. And so the question is, should we freak out, or how freaked out should we be? And I'm here to tell you, step away from the ledge and why why I say that. I was recently at a conference. This is a big conference in Washington, D.C. I just got back last night with probably 1,500, 1,700 people there, big keynote speakers, the whole deal. And I know that not everything went according to plan. I noticed that there were a couple problems with the speakers and some other logistical things that happened. And I know the organizer, and she was cool as a cucumber. And so I went up and I talked with her. I'm like, wow, how can you stay so calm when a couple of things really didn't go the way it was supposed to? And she said to me, I thought very, very wisely, she's like, Mike, that's why I do all the planning in advance. I'm here to execute the plan. That's why it's called a plan. Conference organizers who are running around like a chicken with their head cut off are those that haven't done planning in advance, because when a problem happens, it's too late. You've already have to have a plan that you can stick to, and you just work through it. You just know that nothing is going to go perfectly. There's going to be some speed bumps, and it's just part of the deal. So with that as a lead-in, the people who should be concerned are those with a short time horizon. Okay, if your short time horizon is 6 months, 12 months, maybe even 18 months to 2 years, and you're undiversified and you don't have a plan, well, and you're going to need that amount of money, you shouldn't be investing in the stock market. In my opinion, I've said this time and time again in all these videos that if you have a short time horizon, and in my mind, I think of that as 1 year, 2 year, or even less, it's inappropriate, because the stock market goes through, the unmanaged stock market indexes go through ups, downs, and sideways, and that is too short of a time horizon for there to be a cycle. Okay, if you are undiversified, that's not very smart, because individual stocks can take a very long time in order to bounce back, if they bounce back at all. And you should be concerned if you don't have a plan that includes stocks and bonds of some diversified nature, even though having a diversified portfolio does not guarantee against loss in a generally declining market. If you do not have a plan like that, that's the reason why you have it. Bonds have a tendency to pull things up when stocks go down, and the other way around. And you've got to find a plan that works for you, because investor behavior is what hurts most people. That has been my experience in 24 years, is that people ignore and then overreact. And I certainly don't do that. And I'm here to tell you, if you want to be, in my mind, the smart money, you're not going to do that either. People have a tendency to wait too long to get into the market. Let's think about 98, 99, 2000. My gosh, you were a fool if you didn't get into the internet stocks, because everybody made money there and you can't lose. And how could you be so foolish to be diversified? You need to go all into this. Well, that was, of course, was the wrong time to buy. The market goes down, and then people say, well, this obviously isn't for me, right before the market rebounded back all through the 2000s. I remember in March of 2009, you couldn't find somebody who wanted to, it felt like I couldn't find someone who wanted to invest in equities and in stocks, when really that was the time that made the most sense. So our emotions cause us to do the wrong thing at the wrong time. Okay, so let's talk for just a little bit about just 100% stock market index. I'm going to put up on the chart there on the screen something that I do on almost every single video, it seems like. And what you're going to see, the bottom number are the red numbers there. It is normal for there to be declines of even double digits throughout the year. And if you go back and watch every one of my videos for the last 3 years, I've been saying that every time it happens, people get all concerned, when in fact that is the norm. The thing that has been unusual is that the last 2-3 years it has been unusually not on the downside. Okay, so what we have seen in the last week or two has been so alarming because it has happened very quickly over a week or so. In a future video, I'm going to talk about some of the reasons. I'm going to dissect them. But if you've got a diversified portfolio, okay, which is what you should have, I'm going to throw another chart up there on the screen. You're going to see at the far left-hand corner 1 year, and then the second grouping of bars is 5 years, 10 years, and 20. The big green bar there is over the last 64 years, the high for 100% stock market index S&P and the low. And so you can see there's huge highs and huge lows. But then when you look at the second bar in that grouping is bonds. Bonds have a tendency to not have the high highs and not have the low lows. And when you group them together, it brings down and has a tendency to bring down the highs and bring up the lows. When we look to the second grouping, which is a 5-year time horizon, okay, not 1 year, not 2 year, historically a combination of 50-50 stocks and bonds has never had a losing 5-year time horizon going back 64 years, when in fact, of course, it could in the future. Okay, I can't guarantee what's going to happen the next 5 years, but I do know that historically the odds are in our favor, I believe, that if we have a diversified portfolio, that is the way to go. I'm going to put up on the screen talking a little bit about investor behavior. At the top of the screen, you're going to see starting in October of 2007 all the way through 2008 and all the way to the decline of 2009. And you're going to see the top two lines did decline, but they very quickly came back because they were diversified. The bonds had a tendency, and the bottom one, by the way, was 100% stock market index, which you shouldn't be in anyway for most people. I mean, if you can have your investments for a long time, multiple, and you can handle, you just put it in a shelf and you say, no matter what, I'm not going to lose an ounce of, a minute of sleep, then that might be the answer for you. I don't know. I'm giving very general thoughts here, but that might be the answer. Most people, though, get concerned. So that's why we have to know what our investor behavior is. We want to be the smart money. And so therefore, we usually include some bonds in there, which has a tendency to buffer some of the downs and unfortunately also buffer some of the up as well. When we look at those lines, I'm going to throw it back up on the screen there, you're going to see that within pretty quick order, and this is even after that horrible 2008, it came back. Okay, so one thing that we have to ask ourselves is, what is our conviction? If you don't believe that 2, 5, 10, 20 years from now, the United States, and that's where the majority of most investors' money is, if you don't believe that the United States is the bet that you want to make, why do you have any money in it? Okay, but if on the other hand, your time horizon is 5 years, 10 years, 20. And if you say, wow, I believe that in comparison to the rest of the world, we've got the best ingredients, we've got the best workforce, we've got the best in comparison to others, or the theory of relativity. I'm throwing in some Einstein for you. Then this is part of the deal. I mean, we've got to stay invested and we stay calm. And this is a buying. The world can be really scary if you let it be scary, or it can be a world of opportunity if you let it be a world of opportunity. Warren Buffett, and I've said this many times, Warren Buffett has said that be greedy when others are fearful, fearful when others are greedy. And people are fearful right now. This is a wonderful opportunity if you believe 5 and 10 years down the road, and you've got a time horizon that is long. And most people have a long time horizon. If you're within 2 or 3 years of retirement, I have to tell you, unless you plan on dying the day after you retire, you got another 20, 30 years probably to live even after retirement. If you're in retirement, you're in your 70s, your probability of you and your spouse, one of the two of you is going to live into your 90s. Okay, that's just the actuarial reality of it. And so what works for us is our time horizon. We have a plan of stocks and bonds. We have a positive conviction, which I personally do, and we don't ignore and then overreact because, frankly, your unsophisticated investor has a tendency to wait too long to get in and then get out right at the wrong time. And that's why we have a plan. We think about it in advance so that, frankly, we're cool as cucumbers when this happens. Okay, we're not scared by Kramer on MSNBC, no, not MSNBC, CNBC, and all of the TV. The best thing for this are the news channels and all the newspapers, because people, if you want to see negative, you're going to see negative. If you want to see positive, you can see positive. Frankly, I try to take both of them. I try to be agnostic, although I have to say my conviction is that I see the positive in there, and there's a buying opportunity from my point of view. I have no idea if 1 or 6 months from now, the market's going to be higher or lower than it is right now. I believe that it's going to be equal or greater. I'm not going to lie to you, not 1 month perhaps, but 6 months from now. But I could be wrong. I could absolutely be wrong. I could be wrong a year from now. But you know what? If your time horizon's a year, you shouldn't be in it anyway. Okay, so it's an academic discussion that we're having right now. That's why you have stocks and bonds meshed together in a diversified portfolio with a time horizon and with a plan that works for you. Okay, there is, I said something about a scary place just in the last couple of years. I just want to throw out some topics here. Remember how scary the flash crash? This is just what we saw in the last couple of years. The debt ceiling. Okay, the S&P downgraded the U.S. government. Europe almost collapsed. The Greece almost collapsed just last month. I mean, the emerging markets is not going to take down the world. Okay, that's my opinion. That's my stake in the sand that I'm going to throw out there. Okay, but emerging markets should be a minority of your portfolio anyway. Is it going to affect the U.S. portion of your portfolio? Yeah, it could. Okay, but even Greece. Greece is incredibly small compared to, they're $185 billion GDP. We're 14, 15 trillion. Okay, they're 1%, less than 1% of us. So, there's always things out there that are scary. That's why we have the plan in advance. I'm going to continue with videos throughout, assuming that some headlines happen. I'm going to try to explain. I'm not going to do them super long. This one now, as I look at my clock, looks like a really long one. I'm going to try to keep them shorter so that they are pithy, but that you know that I'm on the job over here watching things on your behalf. 303-747-6455, Mike Brady, Generosity Wealth Management. Give me a call if there's anything I can do for you. Talk to you later. Bye-bye.